Hey traders, it's Ace Trading again, coming at you on this fine Thursday morning. Just want to do a quick video on different ways that you can filter a much broader list of stocks down to something more manageable. Some people don't have access to Bollinger Band width, criteria. Maybe it's not something that's available in their charting package. But there's possibly other ways that you can find what you're looking for. Because ultimately, what we're looking for are these tight compression areas that form almost like a launching pad for the stock to move out of and be able to run for a few days. So, if we just kind of do what we normally do, if I just take these 80 Express and 80 Extender scans and I just dump these things onto, just a general list, you can see we have 134 stocks. The other day we only had, I think it was 87, 90 stocks. So like you can see that this number here is expanding, which, that's oftentimes that's a good thing. But what you can do, like I said, I usually use the ADR percentage related to the intraday Bollinger Band. The one of the downsides about TC2000 is you can't scan across two time frames. So if I'm using a daily ADR, I can't have a scan where I'm also like comparing that against an intraday Bollinger Band width, for instance. So like that's something I've never been found to be possible. If it is possible, I'm just not aware of it. So I often have these columns here where I can quickly compare the two and kind of see where the stock is as far as its compression relative to its average. But another way you could do this, and this is something that I learned from Dave Landry a long, long time ago. He used to use the historical volatility. He would basically take the 5-period historical volatility and divide it by the 100-period historical volatility. And one of the things he was looking for was finding areas or times where the 5-period was at around half of what its long-term average was. So essentially you're taking a short-term volatility average and you're dividing it by a long-term average, and you're just finding areas where the short-term volatility is compressed or contracted relative to that longer-term average. So I mean we can pretty much do the same thing here. If you just, in TC2000, I just duplicated this column, and if we just look at the criteria, so right now it's covering a 20-period range. So if we take that same concept of taking a short-term average and dividing it by a long-term average, essentially what we would end up doing is, right now you can use 3 periods or 5 periods or whatever you want to do, but the idea is you're taking a short-term average of the ADR and you're dividing it by a longer term average. And you got to make sure your formula is correct and that you have the right sort of parentheses and stuff in there, because if this thing is red or showing negative, that means you have something off with your formula. But again, I'm taking a short term, let's say 3-period ADR, and I'm dividing it by a long period ADR. And, this could be 5 and 100 like Dave Landry put. I mean, it's one of those things where you can put a whole range of things that are acceptable. Things that wouldn't be acceptable is that, like, if you put a 3 and then a 5, like those are too close together. You want some kind of spacing between those two numbers. That makes sense. So this is roughly 1 month of activity. This is roughly just a couple days of activity. And essentially what this is going to do is help locate stocks that are either expanded or compressed relative to their averages. So if I sort this number, you can imagine if the short-term average is 2 or 3 times the long-term average, that means it's already moved. It's either expanded out or broken down, or it's just in this sloppy range, because that's what this number, if it's above 1, or especially if it's much higher than 1, these are not going to be situations that you're going to be using as a starting point for finding good swing trades. So like if we go through these, you can see like this thing has already run massively. You don't want to be starting here. I mean, this might be a good list to find parabolic shorts if that's your sort of thing. I know that's something that Kulamagi often talked about. So like I would use this maybe as a potential for parabolics, but I would certainly not use it as a starting point for like long swing trading. And I don't have to go through many of these, but you can see like the price action is just sloppy and all over the place, and this is not a good starting point, for swing trading. So like you can almost, in some cases, outright dismiss like anything on this higher end is not going to be something that you're going to be trading. And this could be another way to kind of quickly help filter down your list. So like if this was my main sort of dumping ground, and I'm just trying to whittle it down to, a handful of, let's say 20, 30 stocks, you could probably start on this end and just start eliminating shit, because these are not going to be things in most cases that you're going to want to trade, because there's just not a good starting point. And you can see, like, I can quickly just eliminate these. And again, like if you add the simple criteria that Stockbee talked about, if it's up several days in a row, kick it out. If it's not, if it's not in some sort of 3 to 10 day consolidation that's tight, with contracting price range and contracting volume, all the criteria that Stockbee talked about as far as a good anticipation setup. If it's not meeting those criteria, you kick them out. And this is a good way to kick a lot of things out really quick, because most of these are going to be up several days in a row, or they're going to be really sloppy and not forming, that nice tight compression area. And part of this is because of the CPI yesterday. A lot of things gapped down and reversed, and there's a bunch of sloppiness and volatility in the market right now. So it might take another week for some of these things, even if the market goes higher from this point. It might take another week or two for things to unscrew the patterns, because a lot of charts got damaged on the CPI report, and there's a lot of volatility with things. And ideally that's not the place you want to be starting from. If there's a lot of uncertainty, that increases the volatility in the charts. And again, you can just see that these are just not the right kind of look. Now, if I sort this the other way and I go from smallest to largest, then we can naturally assume that these ones that are, 40% or 50%, maybe even 3/4 of what the long-term ADR is, that's going to be a really fertile ground for finding tight compression areas. That doesn't mean this thing's going to spit out some magical list and everything's going to be tradable. You still have to put the stock into context of its moving averages, and you still need to do all of the other rigor and analysis technically on the stock. But this is a good starting point. So if I go to CGEM, you can see it's been trading pretty tight the last couple days. This might be something that if it were to break out here, that might be a good bounce off the moving averages sort of play. And again, this is going down 3 days in a row, 4 days in a row. It's okay, this isn't exactly what you're looking for. You're looking for a tight compression, higher lows. So yeah, so even though this is coming through with a very low value, that doesn't automatically mean it's buyable or that it's a good trade. So this one doesn't have the right kind of look. Again, this one's been kind of wedging up. Maybe if this kind of drifts sideways for a few days, maybe that's a little bit better. Again, this is drifting up. So I don't want you to think this is some sort of magical way to spit out some perfect list, but you can imagine a few days ago when Vera was in this tight range, it was coming out on this list on this other side of where it had a very narrow compression compared to its average. But right now it's it's sort of doing the same thing, but it's just not in a great spot. Oh, and one thing that I forgot to do is turn off the pre-market stuff. So that is messing up a few of the numbers. So if I kind of refresh this, and right now I'm just talking conceptually, if you do this process daily, you're going to be frequently in touch with the stocks that are compressing relative to their averages. The CURA or KURA, it's the last couple of days have been tight, but this thing is looking promising, but it's going to have to get some oomph and push out at this base, because right now it just keeps bleeding out, and it's the demand that was here is just slowly disappearing. And that's not to say these kind of situations can't work, but the longer this thing just kind of bleeds out, Dave Landry has this concept called too tight for too long. So tightness is good when it's short term, but when it starts getting too tight for too long, then it's you can start to sit there and suspect, okay, something's off. Because if there was true demand in this thing, then it wouldn't be sitting there continuing to just bleed out and just there's no demand coming back into it. Honestly, that's not really a situation you want. Fusion, it kind of keeps pulling sideways and looking decent. This is one I've been watching for a breakout. And again, that's the thing with breakouts is you don't know when they're going to break out. So if I were to preemptively just buy this thing early somewhere in this compression, I could just be sitting here for several days or several weeks, or even for Cura, if I bought this thing back here expecting a breakout and it just kept going like that, it's okay, that's not what you're looking for. You're looking for 3 to 10 sort of tight sideways compression days. So again, it's starting to look right, but it needs more time. This thing is kind of starting to set up, but it's starting to break through the 10 now. So again, if this thing keeps dropping down, it's not really what you're looking for. So as you go from the smallest value here to the largest, it'll get increasingly less likely that it's something you want to trade. And again, a lot of things right now are really sloppy because the CPI kind of fucked a lot of things up. So there's probably not going to be a ton of things. A lot of things reversed, or they sold off and then they reversed, and then yesterday the market was up decently. So there's like this kind of like V-shaped sloppiness in a lot of charts. That's really not what you're looking for. Ideally you're looking for stuff like this where it's tight, compressed, and moving sideways, and not a lot of volatility and sloppiness. So I can quickly go through this list. I'm not seeing a ton of stuff right now. This might be something that might break out of this range here, but this one looks a little sketch. So again, this was just a quick video to show how you can just add another way of trying to find compression areas other than what I normally talk about as far as ADR and Bollinger Bandwidth. And that's the whole idea, is like these scans are just tools. The whole point is knowing what you're looking for to begin with. Like if you know you're looking for compression areas, okay, that's your fundamental basis of what you're looking for. There can be 3 or 4 or 5 different ways that you arrive at finding those sort of things. But at the end of the day, you're looking for the same thing. These scans are just tools to help you pull those things out. You don't even need a scan. I mean, you can just visually go through the charts and look for areas of compression. That's one way to do it. This just kind of helps make it more efficient. So like I said, like if you know that this larger number here is 99.9% of the time not going to be in a compression or coming out of a compression, that's a good thing to know. You can probably just whole blanche carte eliminate most of these, because I don't even have to look at these things to know that they're sloppy and loose. Even if I just quickly go through, if you just look at the chart, you can see that it's just not a compression area. It's not a 3 to 10 day sort of tight range that you want this thing to be coming out of. This looks like it might be setting up. It's like it's got day 1 of a compression where it finally had a nice tight day, but it's like, okay, I would want a couple more days of tightness and maybe have the 10-day catch up a little more, so that this thing breaks above 30. It's like, okay, maybe this thing is something that could run, but it's like right now it's just not ready yet. You want to get stocks when they're ready. Again, like these are still above 1, so it's like my expectation of any of these looking like they should look is extremely low. They're just loose and sloppy and wide, and that's not a good starting point. This is another one where it's like it's starting to build higher lows. You can see if you were to draw some sort of trend line here, you can see it's starting to look like it should, but I would want this thing to kind of compress a little more, and maybe it doesn't keep compressing. Like it doesn't care what I want. Like it could break out of this thing today for all I know. But you should have an idea in your head of what you're looking for, and use these tools to just kind of make your processes more efficient. And if I know, I can just get rid of all, like we just looked through all these, and they all looked wide and loose and sloppy. If you just keep doing this process, this 130 stocks we started with is eventually going to be something much, much smaller than that. And then once you start putting things in context, you start looking for tight compression areas and putting them in context of the moving averages and things like that. Then you'll take that 130 something stock list and you'll whittle it down to something a lot more manageable, 20, 30 stocks. And that's kind of where you want to be at, this small handful of stocks. That way when the market opens, you can sort them by volume buzz, you can sort them by price change, and you can kind of use that as your basis of taking that 20 or 30, and now I'm nailing down the couple of stocks that I want to trade for that session. So again, use this as another tool to help you narrow down on stocks that are having a compression, or to help you eliminate stocks that are too wide and sloppy very quickly. You can use this sorting function here. Or like I said, you might be able to use it as some sort of mechanism to find parabolics, which is a completely separate setup. That would not be a bad idea, honestly, if it meets a parabolic sort of criteria. But again, use this thought process of taking a shorter term volatility reading and dividing it by a longer term volatility reading. All right, I hope you thought this was helpful, and let me know if you have any questions or comments.